Hello and welcome. In this chapter, we will discuss common implementation challenges, practical solutions, and frequently asked questions under IFRS 9 or BFRS 9 in Bangladesh. In the earlier chapters, we discussed the principles of IFRS 9, classification and measurement, expected credit loss, PD, LGD, EAD, data requirements, governance, disclosure and implementation roadmap. Now we will focus on real-life challenges. Understanding the accounting standard is one thing. Applying the standard using actual bank data, borrower information, collateral records, recovery history and system reports is much more challenging. IFRS 9 requires banks to estimate expected credit losses using historical information, current conditions, and forward-looking information. This means a bank cannot wait until a borrower defaults before recognizing credit loss. The bank has to identify possible credit risk earlier and recognize provisions based on expected losses. This creates practical challenges in many areas. For example, historical default data may be incomplete, collateral valuation may be outdated, rescheduled loans may be difficult to classify. Finance, risk, credit, and IDD departments may not have the same data. Management overlays may not be properly supported. Auditors may ask for detailed documentation. Therefore, this chapter is designed to help banks, auditors, and finance professionals understand the common problems and how to address them practically. The objective is not only to identify challenges, but also to provide usable solutions, examples, and learning points. The first major challenge is lack of historical default data. Historical default data is necessary for calculating probability of default, or PD. PD means the likelihood that a borrower will default within a particular period. For Stage 1 assets, banks use 12-month PD. For Stage 2 assets, banks use lifetime PD. To estimate PD, the bank needs to know how many borrowers defaulted in the past and what type of borrowers defaulted. However, many banks may not have complete historical default data. This may happen because old records were maintained manually, system migration was not properly done, default definitions were not consistent, or recovery and classification records were not linked with loan accounts. Let us take an example. ABC Bank wants to calculate PD for SMI loans. In 2023, the bank had 50 SMI borrowers and 180 borrowers defaulted. The default rate is 180 divided by 50, which is 3.60%. In 2024, the bank had 500 SME borrowers and 220 defaulted. The default rate is 4.00%. In 2025, the bank had 60 SME borrowers and 270 defaulted. The default rate is 4.50%. The average default rate is approximately 4.03%. So, the bank may initially estimate SME 12-month PD at around 4%, subject to adjustment for current and future conditions. But there may be a problem. If some default dates are missing, or if some rescheduled borrowers were not properly identified as defaulted, the PD may be understated. The practical solution is to collect data from core banking, credit, classification, recovery, and legal records. The bank may reconstruct missing default dates using classification history, apply one approved default definition, document data limitations, and gradually improve data collection going forward. The key message is, lack of perfect data does not stop implementation, but all limitations must be clearly documented. The second challenge is inconsistent definition of default. Default definition is very important because it affects PD calculation, Stage 3 classification, model validation, and disclosure. If different departments use different definitions of default, the ECL result will not be reliable. For example, the finance department may consider default based on non-performing classification. The credit department may consider default based on borrower behavior. The recovery department may consider default only and legal action starts. The risk department may consider default based on days past due. This creates confusion. Let us take an example. A borrower is 100 days past due. Legal action has not yet started. The borrower is still discussing repayment with the bank. The credit team says the borrower should not be treated as defaulted because negotiation is ongoing. The finance team says the borrower should be Stage 3 because the loan is more than 90 days past due. The correct approach is to follow the bank's approved default definition. A practical default definition may include more than 90 days past due, unlikely to pay in full, non-performing classification, legal recovery action, bankruptcy, liquidation, restructuring due to severe financial difficulty or write-off. The definition should be approved by management and applied consistently across all departments. The key message is, one bank should have one approved default definition for IFRS 9 purposes. The third challenge is identifying significant increase in credit risk, commonly known as SICR. This is one of the most judgmental areas under IFRS 9. A loan moves from Stage 1 to Stage 2 when credit risk has increased significantly since initial recognition. This is very important because Stage 1 uses 12-month ECL, while Stage 2 uses lifetime ECL. Therefore, movement from Stage 1 to Stage 2 can significantly increase the provision amount. Let us take an example. XYZ Trading Limited has a working capital loan of BDT 100 million. At origination, its internal rating was Grade 3 PP was 3%, repayment was regular, and the loan was in Stage 1. After 2 years, the internal rating deteriorated to Grade 6, PD increased to 12%, sales declined by 30%, gross profit margin declined, and the borrower requested temporary repayment relaxation. The loan is only 10 days overdue. Now the question is, should the loan remain in Stage 1 just because it is only 10 days overdue? The answer is no. Even though the loan is not more than 30 days past due, the borrower's credit risk has increased significantly. The bank may move the loan to Stage 2 based on rating downgrade, increased PD, sales decline, weak cash flow, and repayment support request. Let us see the ECL impact. If the loan was in Stage 1, with EID of BDT 100 million, PD of 3% and LGD of 40%, ECL would be BDT 1.20 million. If the loan moves to Stage 2, with lifetime PD of 12% and LGD of 40%, ECL becomes BDT 4.80 million. So, ECL increases by BDT 3.60 million. The key message is, SICR should not be assessed only by overdue status. A loan can be current or only slightly overdue, but still move to Stage 2 if credit risk has significantly increased. The fourth challenge is stage classification error. Stage classification determines whether a loan is in Stage 1, Stage 2, or Stage 3. Incorrect staging may materially misstate the ECL allowance. Common errors include keeping weak loans in Stage 1, not moving rescheduled loans to Stage 2, treating all regular loans as Stage 1, ignoring watch list status, not identifying Stage 3 indicators, and applying different rules across branches. Let us take an example. A borrower had a term loan of BDT 80 million. The borrower could not pay installments due to cash flow problems. The bank rescheduled the loan by extending the repayment period. After rescheduling, the borrower is paying regularly. The system shows the loan as current. Should the loan automatically remain in Stage 1? Number. If the loan was rescheduled because of financial difficulty, it may indicate significant increase in credit risk. The loan may need to be classified as Stage 2 or even Stage 3, depending on the severity of the borrower's condition. The practical solution is to prepare exception reports for rescheduled, restructured, watchlisted, and downgraded loans. These accounts should be reviewed separately for staging. The key message is: staging should reflect actual credit risk, not only current payment status. IFRS 9 implementation requires change management because it changes how the bank thinks about credit risk, provisioning, reporting, and accountability. Common challenges include resistance from departments, lack of understanding, fear of higher provisions, data ownership disputes, system limitations, reliance on old regulatory provisioning mindset, and weak coordination between finance and risk. To manage these challenges, the bank should communicate the importance of IFRS 9 clearly. All relevant departments should be involved early. Now, training should be practical. Data ownership should be clearly defined. There should be a formal issue resolution process. Senior management support should be visible. Progress reporting should be regular. Decisions and assumptions should be documented. A communication plan helps stakeholders understand implementation progress and responsibilities. For example, ABC Bank holds project committee meetings every 2 weeks. Senior management receives monthly progress reports. The board or audit committee receives quarterly updates. OT, finance, and risk teams review data issue logs weekly. Training sessions are conducted as per the training plan. Audit readiness meetings are held monthly. Good communication reduces confusion and keeps the project on track. The sixth challenge is weak recovery data for LGD calculation. LGD depends on how much the bank recovers after default. To calculate LGD properly, the bank needs recovery history. However, many banks may not have recovery data linked with original loan accounts. Let us take a simple example. The bank reviews 5 defaulted loans. Loan 1 had exposure at default of BDT 100 million. Net recovery after cost was BDT 65 million. So, loss was BDT 35 million. Loan 2 had exposure of BDT 80 million. Net recovery was BDT 36 million. Loss was BDT 44 million. Loan 3 had exposure of BDT 50 million. Net recovery was BDT 18 million. Loss was BDT 32 million. Loan 4 had exposure of BDT 120 million. Net recovery was BDT 82 million. Loss was BDT 38 million. Loan 5 had exposure of BDT 60 million. Net recovery was BDT 22 million. Loss was BDT 38 million. Total exposure was BDT 410 million. Total loss was BDT 187 million. LGD is BDT 187 million divided by BDT 410 million, which equals approximately 45.61%. The bank may use approximately 46% as historical LGD for similar loans, subject to adjustment for current and future conditions. The practical solution is to build a recovery database, including loan account number, default date, recovery amount, collateral sale amount, legal cost, settlement amount, write-off amount, and time taken for recovery. The key message is reliable LGD, requires reliable recovery data. The seventh challenge is estimating exposure at default for revolving facilities. For term loans, EAD is usually close to the outstanding balance. But for overdrafts, credit cards, and working capital limits, the borrower may draw unused limits before default. Therefore, current outstanding balance may not be enough. Let us take an example. A borrower has an overdraft facility. Approved limit is BDT 100 million. Current outstanding is BDT 60 million. Undrawn limit is BDT 40 million. The bank expects that, before default, the borrower may use 50% of the undrawn limit. Expected additional drawing will be BDT 40 million multiplied by 50%, which equals BDT 20 million. Therefore, EAD will be current outstanding of BDT 60 million plus expected additional drawing of BDT 20 million. Total EAD is BDT 80 million. Now assume PD is 10% and LGD is 45%. ECL equals 10% multiplied by 45% multiplied by BDT 80 million. ECL is BDT 3.60 million. If the bank incorrectly uses only the current outstanding balance of BDT 60 million, ECL will be BDT 2.70 million. So, ECL will be understated by BDT 0.90 million. The key message is, for revolving products, EAD may be higher than current outstanding balance. The eighth challenge is incorporating forward-looking information. IFRS 9 requires banks to consider future economic conditions in ECL measurement. This is challenging because the future is uncertain. Banks need to identify economic variables that affect borrower repayment capacity. Examples include GDP growth, inflation, interest rate, exchange rate, export growth, import cost, unemployment, property price, and industry performance. Let us take an example. ABC Bank has significant exposure to import-based SME borrowers. The bank expects depreciation of Bangladeshi taka against the US dollar, higher import cost, increased interest rate, and reduced customer demand. These factors may increase default risk for import-based SMEs. The bank prepares 3 scenarios. In the optimistic scenario, probability weight is 20% and PD is 5%. In the base scenario, probability weight is 60% and PD is 8%. In the pessimistic scenario, probability weight is 20% and PD is 14%. Weighted PD will be 20% multiplied by 5% plus 60% multiplied by 8% plus 20% multiplied by 14%. This equals 1% plus 4.8% plus 2.8%. Total weighted PD is 8.6%. The bank may use 8.6% as probability-weighted PD for this portfolio. The key message is forward-looking information should be reasonable, supportable, and linked to credit risk. The ninth challenge is management overlay without proper support. A management overlay is an adjustment to model output when management believes the model does not fully capture certain risks. Overlay may be necessary, but it must be supported by evidence. Let us take an example. The ECL model calculates BDT 10 million ECL for the import-based SME portfolio. Management believes that the model does not fully capture recent exchange rate volatility. Therefore, management proposes a 10% overlay. Overlay is BDT, 10 million, multiplied by 10%, which equals BDT 100 million. Adjusted ECL becomes BDT, 100 million. But this overlay must be properly documented. A weak explanation would be: management believes more provision is required. This is not enough. A stronger explanation would be: import-based SME borrowers are exposed to 12% exchange rate depreciation, increased 50 settlement cost, and lower customer demand. Based on stress analysis, management applies a 10% overlay on model ECL for this portfolio. The overlay memo should include reason for overlay, affected portfolio, amount, calculation basis, supporting evidence, approval authority, expected duration, and review date. The key messages: management overlay should be evidence-based, not arbitrary. The 10th challenge is overdependence on Excel. Many banks may use Excel for the early implementation because it is flexible and easy to use. However, Excel creates risks if not properly controlled. Common risks include formula errors, wrong cell references, broken links, unauthorized changes, version confusion, manual input errors, no audit trail, and accidental deletion. Let us take an example. A bank calculates ECL in Excel. Formula for one portfolio accidentally excludes Stage 2 SME loans. As a result, total ECL is understated by BDT 250 million. This type of error can create serious audit and reporting issues. If Excel is used, the bank should apply strong controls. Formula cells should be locked. Access should be restricted. Version control should be maintained. Input data should be reconciled with source systems. Formulas should be independently reviewed. Worksheets should be protected. Change logs and backup files should be maintained. Manual adjustments should require approval. The key message is: Excel may be used as an interim tool, but it must be controlled and auditable. The 11th challenge is reconciliation between ECL model output and the general ledger. The ECL model may produce one number, while the general ledger may show another amount. This can happen due to manual journal entries, write-offs, recoveries, timing differences, portfolio mapping differences, or data extraction issues. Let us take an example. The ECL model output is BDT 311 million. The ECL balance in the general ledger before adjustment is BDT 950 million. The difference is BDT 361 million. This means an additional impairment journal is required. The journal entry will be debit impairment loss expense BDT 361 million. Credit ECL allowance BDT 361 million. Before posting this entry, finance should confirm that the model output is approved, reconciled, and reviewed. The bank should reconcile ECL model output with finance records, general ledger, core banking system, write-off records, recovery records, and disclosure tables. The key message is: ECL output must be reconciled with the general ledger before financial reporting. The 12th challenge is the difference between accounting ECL and regulatory provision. In Bangladesh, banks may need to calculate how both IFRS 9 ECL and Bangladesh Bank regulatory provision. These two amounts may not always be the same because the basis of calculation may be different. Let us take an example. ECL allowance under IFRS 9 is BDT 311 million. Regulatory provision required under Bangladesh Bank basis is BDT 850 million. The regulatory provision is higher by BDT 539 million. The bank must explain why the difference exists and how it should be treated. The bank should maintain separate calculation of IFRS 9 ECL and regulatory provision. It should also prepare reconciliation between the two, explanation of differences, board review, management approval, and audit support documents. The key messages: differences between accounting ECL and regulatory provision should be clearly reconciled and documented. The 13th challenge is lack of staff training and weak documentation. IFRS 9 affects many departments. If only the finance team understands IFRS 9, implementation will be weak. Credit officers need to understand early warning signs, and SICR risk teams need to understand PD, LGD, EID, and staging. IT teams need to understand data extraction and system controls. Internal audit needs to understand control testing and audit readiness. Senior management needs to understand financial impact and key judgments. Let us take a practical example. A branch officer renews a borrower's facility and updates it as regular in the system. However, the borrower was repeatedly requesting repayment relaxation due to cash flow problems. If the branch does not report this information, the loan may incorrectly remain in Stage 1. This shows why training is important for branch and credit staff. Documentation is also equally important. A bank may calculate ECL correctly, but if it cannot explain and support the calculation, auditors may challenge it. Common documentation gaps include no approved methodology, weak explanation of assumptions, no support for management overlay, no model validation, no reconciliation, and incomplete disclosure working papers. The practical solution is role-based training and strong documentation. Key messages: in IFRS 9, documentation is as important as calculation. The 14th challenge is coordination gap between departments. IFRS 9 is a bank-wide project. Finance, risk, credit, IT, recovery, internal audit, and senior management must work together. Let us take an example. Finance prepares ECL based on data provided by IT. Risk says staging is incorrect. Credit says some borrower information is outdated. Recovery says collateral information is incomplete. Internal audit says approvals were not documented. This type of coordination gap delays reporting and creates audit issues. The practical solution is to form an IFRS 9 implementation committee. The bank should define a responsibility matrix, hold regular meetings, maintain issue logs, assign data owners, document decisions, escalate unresolved matters, and involve senior management. The key message is IFRS 9 is not only a finance project, it requires coordination across the whole bank. The 15th challenge is treatment of rescheduled and restructured loans. This is particularly important in Bangladesh. A rescheduled loan may become regular after rescheduling, but the reason for rescheduling is important. If rescheduling was granted because the borrower was in financial difficulty, it may indicate significant increase in credit risk or credit impairment. Let us take an example. A borrower had overdue installments for 6 months. The bank rescheduled the loan by extending the repayment period. After rescheduling, the borrower is paying regularly. Should the loan automatically go back to Stage 1? Number: The bank should assess whether the borrower's credit risk has genuinely improved. In many cases, the loan may remain in Stage 2 for a probation or cure period. If financial difficulty is severe, it may remain in Stage 3. Another important issue is sector concentration risk. Banks in Bangladesh may have significant exposure to garments, textiles, trading, real estate, SME, agriculture, and import-based businesses. If one sector faces stress, ECL may increase significantly. For example, textile and garments may be affected by export demand and energy cost. Trading and import businesses may be affected by exchange rate pressure and import cost. Real estate may be affected by property price decline and liquidity constraints. The bank should reflect sector risk in staging, PD, LGD, management overlays, and management reporting. The key message is, rescheduling should not automatically improve staging, and sector concentration risk should be actively monitored. The 16th challenge is model validation. Model validation means checking whether the ECL model is reasonable and fit for use. Many banks may struggle with validation due to lack of technical expertise or limited historical data. Let us take an example. ABC Bank estimated SME PD at 4%. After 1 year, actual default rate was 5.5%. This indicates that the model may be understating default risk. The bank should ask, is the default definition consistent? Is historical data complete? Are PD assumptions too low? Has the economic condition changed? Are Stage 2 loans properly identified? Are sector risks properly captured? Model validation may include backtesting, sensitivity analysis, benchmarking, expert review, comparison with actual defaults and recoveries, review of assumptions, and independent review. Now let us address a few frequently asked questions. Does Stage 1 mean no provision? Number Stage 1 requires 12-month ECL. Does Stage 2 mean non-performing? Number. Stage 2 means credit risk has increased significantly, but the asset is not yet credit impaired. Can a loan be current but still be Stage 2? Yes, if credit risk has significantly increased. Can management use judgment? Yes, but judgment must be reasonable, supportable, documented, and approved. The key message is, models should not be accepted blindly. They must be tested, reviewed, and improved. Let us now summarize the Bangladesh-specific considerations. Banks and financial institutions in Bangladesh should pay special attention to loan rescheduling and restructuring classified loans, recovery delays through legal process, collateral enforceability, collateral valuation, sector concentration, foreign exchange pressure, export market uncertainty, limited historical default data, manual branch records, regulatory provisioning requirements, and staff training needs. The implementation should be practical, phased, and well documented. Banks may start with available data and practical models, but they should continuously improve data quality, system support, model reliability, and governance. Let us summarize the key learning points of this chapter. First, implementation creates many practical challenges, but these challenges can be managed through planning, governance, documentation, and continuous improvement. The most common challenge is relate to historical default data, default definition, SICR assessment, staging, collateral valuation, recovery data, EAD, forward-looking information, management overlay, Excel controls, reconciliation, regulatory provision, staff training, documentation, department, coordination. rescheduled loans, sector concentration, and model validation. IFRS 9 should not be treated as a one-time accounting exercise. It should become part of regular credit risk management, financial reporting, and governance. For banks in Bangladesh, successful implementation will require cooperation among finance, risk, credit, recovery, internal audit, senior management, and the board. A practical, transparent, and well-documented approach will improve audit readiness, regulatory confidence, financial reporting quality, and overall credit risk management. Thank you for watching.